Are you looking for an effective way to unlock your financial potential? Consider the age-old debate of bonds versus stocks. Investing in either can offer significant long-term rewards, but understanding which option is right for you is essential. In this video, we will explain the differences between bonds and stocks and give helpful investing tips. What are stocks and bonds? Stocks are shares of ownership in a publicly traded corporation. When you purchase a stock, you become part owner of that company and can benefit if the company does well. If the company's performance improves, so does the value of your stock, and you can ultimately make money from selling those stocks at a higher rate than what you initially paid for them. Bonds, on the other hand, are a form of debt. When you purchase a bond, you lend money to an entity. The entity promises to repay your loan plus interest at an agreed-upon date. While bonds tend to be less volatile than stocks, they offer lower returns. To learn more about investments, check out our previous video. The pros and cons of investing in stocks. Investing in stocks can be a great way to make money and build wealth. However, it is important to understand the pros and cons of investing in stocks before getting started. Here are the pros and cons of investing in stocks. Pros: significant returns. Investing in stocks can bring huge financial rewards. The potential for significant returns on investments is one of the main reasons people decide to invest in stocks. Diversification. Stocks are a great way to diversify your portfolio and protect against market downturns. Investing in different sectors and industries can spread their risk and reduce their losses. Liquidity. Stocks are liquid assets, meaning you can easily buy or sell them on the stock market in relatively short periods. It makes it easier to take advantage of opportunities when they arise. Cons. Financial risk. Investing in stocks carries a certain amount of financial risk. Markets can go up and down, so there is no guarantee that your investments will always make money. Volatility. The stock market can be volatile and unpredictable, which means you could lose much money if you're not careful. High fees. Investing in stocks often comes with high fees, including trading, brokerage, and taxes. These can quickly eat into your potential profits. Overall, investing in stocks can be a great way to make money and build wealth over the long term. However, it is important to understand the pros and cons of investing in stocks before getting started. Doing so will help you make informed decisions and maximize your chances of success. The pros and cons of investing in bonds. Pros: bonds are typically less risky than stocks, making them a good choice for conservative investors who want to protect their capital. Interest on bonds is fixed and paid out regularly, which makes planning your finances more manageable. There's no need for active management when investing in bonds, as the returns are predetermined. Bonds can provide a steady income stream to investors over time, making them an attractive option for retirement or other long-term investments. Bond prices don't usually fluctuate as much as stocks, so it's easier to predict their returns with greater accuracy. Cons: generally speaking, bond returns are lower than stocks, so investors looking for higher returns may be better off investing in stocks. Bond prices can still fluctuate, particularly when interest rates change. Bonds come with credit risk. If the issuer doesn't pay out on their obligations, you will likely lose a portion or all of your investment. When buying a bond, investors must pay commissions and trading costs, which can affect their returns. Some bonds come with call provisions that allow the issuer to repurchase them anytime, eliminating the income stream to investors. It is another risk associated with investing in bonds. Investors should always read the fine print before investing in bonds. Overall, investing in bonds can be a valuable option for long-term investors looking for steady returns with minimal risk. However, risks are associated with investing in bonds, and it's essential to understand them before getting started. Investors should always do their due diligence and research different types of bonds before investing. Understanding how bond prices and interest rates may affect your returns is vital so you can make more informed decisions. By understanding the pros and cons of investing in bonds, investors can determine if this is a suitable investment. Key factors to consider when deciding between stocks and bonds. When deciding between stocks and bonds, several key factors must be considered. First and foremost, you should assess your risk tolerance. Stocks tend to be more volatile than bonds, so if you're not comfortable with the potential for considerable changes in stock prices over short periods, then it's best to go with bonds. Additionally, you should consider what kind of return you want. Stocks can offer higher returns than bonds in the long run, but they also come with a greater risk of loss. Here are some of the other factors to consider when choosing between stocks and bonds. Investment horizon. Stocks tend to be better suited for investors with a longer investment horizon because stocks generally have higher returns over extended periods than bonds. Bonds may be a better choice if you're looking for something that will provide you with consistent income in the short term. Tax implications. Depending on the type of stock or bond, you may be subject to other tax payments. Take the time to research what these are and decide which one best suits your situation. Suitability of investment. It's important to consider how suitable each investment is for your goals. For example, if you're investing for retirement, stocks may be a better choice than bonds as they can offer higher returns over the long term. To learn more about stocks, check out our previous video. Tips on getting started with investing. Start small. Starting with a relatively small amount of money is best if you're investing. It will help you get used to investing without risking too much and allow you to see how the market works before committing more funds. Invest in yourself. Before you start investing in the markets, invest in yourself. Take a few classes or read books on investment basics to understand how different markets and investments work. Diversify your portfolio. Diversifying when investing is essential to spread your risk across investments such as stocks, bonds, mutual funds, and ETFs. Pay attention to fees. Investing can be expensive if you ignore the costs associated with different investments. Look for low-cost options that will help you keep more of your profits. Set realistic goals. When investing, you must have realistic expectations and set reasonable goals. Don't expect to get rich overnight. Instead, focus on long-term investments to help you achieve your financial objectives over time. Monitor your investments regularly. Just like anything in life, investing requires regular monitoring and maintenance. Keep track of your assets and make sure you're staying on top of the markets. Have a plan. Last but not least, always have a plan when investing. Know what you want to achieve and how you'll get there before you start investing your money. It will help ensure that you stay on track and reach your goals. By following these tips, you can start investing on the right foot. With some knowledge and patience, you'll be well on your way to achieving financial freedom. Are you looking for financial freedom? Cryptocurrencies may be your ticket to success. With a thorough understanding of market trends and trading skills, you can be empowered to make sound decisions when trading. Technical analysis is just one great way to stay ahead of the game. Technical analysis can help you better understand the market and spot opportunities when investing in cryptocurrencies. Check out this technical analysis tool we recommend. Affiliate disclaimer: Moovmynt is supported by the people. When you purchase through links on our site, we may earn an affiliate commission that helps keep our website and its content. Learn more. TradingView is a powerful yet easy-to-learn platform that provides beginners and experienced traders with all the tools they need for success. Whether you are just getting started or looking to brush up on your skills, there's something here. From indicators and chart patterns to basic technical analysis principles like trend lines, which will help keep tabs on when it might be time to enter long trades. Check out TradingView today. To learn about social media marketing jobs, check out our previous video. What's the difference between stocks and bonds? There's a big difference between bonds versus stocks. When you invest in stocks, you buy ownership in a company and share in its profits or losses. On the other hand, bonds are debt instruments where an investor loans money to a corporation or government for a fixed period at a fixed interest rate. Bonds are less risky than stocks because they offer regular income through interest payments. However, because the return on a bond is typically lower than that of stocks, investors may miss out on some potential gains if stocks appreciate over time. Fixed income securities, such as bonds, offer investors a way to diversify their portfolios with low-risk investments that generate consistent income and interest payments. On the other hand, stocks provide an opportunity for higher returns but can be volatile and unpredictable. Investment portfolio diversification is essential for long-term success, so investors should consider stocks and bonds when constructing their portfolios. Investment-grade bonds, such as treasury and corporate bonds, are less volatile than stocks and can offer stability to an investor's portfolio. Municipal bonds, which local governments issue to fund projects such as roads and bridges, can provide tax advantages. Equity securities, such as standard and preferred stocks, offer investors the potential for higher returns but with more risk. As with all investments, diversification is key to reducing overall portfolio risk. By investing in both stocks and bonds, investors can spread out their risks while still having a chance to earn potentially higher returns over time. Are you looking to add some excitement and potential profits to your portfolio? Cryptocurrencies provide a unique way of diversifying, with the chance for rewarding returns. However, it's also essential to keep your investments safe. Hardware wallets are a practical solution that protects assets from harm while maintaining accessibility. Check out this hardware wallet tool we wholeheartedly recommend. Affiliate disclaimer: Moovmynt is supported by the people. When you purchase through links on our site, we may earn an affiliate commission that helps keep our website and its content. Learn more. Ledger wallets are the top choice for cryptocurrency users looking to keep their digital assets safe. With strict safety measures in place, there's no risk of compromise during transmission, so you can trust that your money is secure. Invest with confidence and check out Ledger wallets today. Final thoughts. Regarding investing for the long term, there are two primary options: bonds and stocks. Bonds can be an excellent option for those looking for a safe, reliable way to invest their money and generate steady returns over time. Stocks can offer the potential for much higher returns over the long term, but they also come with more risk. Ultimately, it's important to assess your personal goals and financial situation before deciding where to invest your money. With the right mix of bonds and stocks, you can maximize returns without exposing yourself to too much risk. So get out there and start investing. Thanks for taking the time to watch this guide on bonds versus stocks. We hope you've learned some helpful information and are now better prepared to make smart investments for the future. Good luck. Disclaimer: Moovmynt provides educational content only. It should not be taken as professional financial advice.